So we have an ICT bullish breaker here, but I want you to think about how the market from this high traded down and then traded up and then through it. What does that make this range from this low to that high? Once we broke out above this high here, which is what we were anticipating, this becomes a balanced price range. What makes it balanced? We had a high, we traded it down, so sell side delivery has been offered, not sell side liquidity. Sell side delivery is any price run from a high to a low. We have had sell side delivery from here and here, that range. Now, when we run right back over that entire range again, from that low up to that high, which is what we're doing here over time, as soon as we break through here, this high to that low is now a balanced price range. There is absolutely no reason to anticipate, expect, or want to see price come back down below that low. Why? Because the focus is up here. So where is the mile markers at going to be? Where's the rest stops along the way? Well, when the market runs above this area here, it's more likely to do what? Treat this level here as a breaker or a springboard to go higher. Why? Because this high has a lower low that's higher than this low over here. So the market comes back down. Does it wick through that high? Absolutely. And that's permissible. Look where the bodies close right here and it opens right there. So there are wicks that are going down into this buy side imbalance, sell side efficiency, which is a BISI. It's a fair value gap, but what specifically stands out here? What is that? What's the segment between this high on that candlestick right there to this candlestick's high? What is this area? It's inefficient. But then when we see this candlestick here trade down into it, it erodes some of this inefficiency. So it starts from here to here. This becomes a breakaway gap. We don't want to see that filled in. Are you telling me the ICT is teaching how to see, anticipate, and work with breakaway gaps? Yes. So we have this area here as a breakaway gap. Why should it stay open? Because it's running out of this range right here. It's already done the work of digging into this daily propulsion block. So I'm going to watch price. I want to see periods where it's going to run aggressively higher. If I get that, then I'm going to be really trustworthy that I'm on side. That means I'm on the right side of the marketplace and stay with the idea. Do we get that confirmation with the body staying at or above this high here? Yes. So the market should be rallying higher. Where should it go? Well, where's the next draw on liquidity? Near term. Yes, this is it up here, but what above this high exists in terms of liquidity? Buy side. So the market right here has buy side. The market draws up into it. What happens before it gets to this run right here? You see this wick right here? Half of that is what? Consequent encroachment. Interesting how it goes right down to it right there. Interesting how we have a gap right there with a wick. So if we have a gap like this with a wick, always trust and allow for it's likely to go into this consequent encroachment, not just fill in that gap right there. So it can trade down, even though it goes over top that gap, the candlestick's high right here. If it went through that live, I would not be unsettled by that. I would look for this candlestick's wick right here, the midpoint, which is consequent encroachment. We treat that as a gap. The market goes right back to it there. Then what does it do? Right back up here. All right, so when the next candle opens up, I would be looking at that and saying, okay, now I want to see it start expanding towards this high here. And I want to see it aggressively run through it. I want to see speed. Well, we get it there. We come back down in. What is it doing? It's working inside this wick, which is what? A gap. We do gradients on wicks. We never want to see, in this case here, lower than 50% or consequent encroachment. So any respect of this wick should be limited to the high, 75% of the wick, and then consequent encroachment, which is half. Go over here, look what it's doing. It's going down, but it won't breach on a closing basis midpoint of that wick. So the market does what? It rallies above this high here. What's above that high? Buy side. Someone is chasing that lower when it's creating that. This is an hourly chart. So inside that weakness in that hourly candlestick, someone's going short. Where they're going to place a stop? Right above that high. So the market does what? It gravitates up to it here, and we drop down, respecting consequent encroachment there, and we rally. What do we do now? We start expanding aggressively towards that weekly mitigation block.